Bonds can be a good investment option for those looking for a more conservative way to grow their wealth. However, for many beginners, bonds can be confusing and difficult to understand. This guide aims to provide a basic understanding of what bonds are, how they work, and why they can be a good investment option. What are bonds? Bonds are debt securities issued by companies, municipalities, or governments. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. How do bonds work? Bonds are bought and sold on bond markets. Companies and governments issue bonds to raise capital, which can be used for various purposes such as expanding their business or funding public projects. When you buy a bond, you agree to lend the issuer a set amount of money for a set period of time, known as the bond's term. During the bond's term, the issuer agrees to pay you a set amount of interest, known as the coupon rate, at regular intervals. At the end of the bond's term, the issuer returns the bond's face value to you. Why invest in bonds? Bonds can provide a more conservative investment option compared to stocks. Because bonds are debt securities, they are generally less risky than stocks and can provide a predictable stream of income in the form of interest payments. Additionally, bonds can help diversify your portfolio and reduce overall investment risk. However, it's important to remember that investing in bonds comes with risk. The issuer of the bond may default on their interest payments or be unable to repay the bond's face value when it matures. Additionally, changes in interest rates can affect the value of your bond investments. Example: understanding bonds for beginners. Let's say that you're a beginner and want to invest $1,000 in a bond. You do some research and find a bond issued by ABC Company with a term of 10 years and a coupon rate of 3%. You decide to buy the bond for $1,000. During the bond's term, ABC Company pays you 3% interest on your $1,000 investment. At the end of the bond's term, ABC Company returns your $1,000 investment to you. In this scenario, you have received a total of $300 in interest payments over the 10-year term of the bond and have received your initial investment of $1,000 back at maturity. This investment scenario represents a relatively low-risk investment option with a predictable stream of income. By understanding what bonds are, how they work, and why they can be a good investment option, you can make informed investment decisions and potentially achieve your financial goals. However, it's important to remember that investing in bonds comes with risk and to not make investment decisions based solely on short-term market fluctuations. It's always a good idea to seek the advice of a financial professional before making any investment decisions.